Cards 101. I'm Annie. I'm one of the community outreach coordinators at the Human Services Center Mon Valley, and I have my colleague Katie here with me.
Hello, I'm also an outreach coordinator with the Human Services Center Mon Valley.
And so, like I said, today we're just going to go over some credit card 101 information. The slides will be provided to you with any links that we have, and this will also be recorded and put on YouTube to view later. Anything I'm missing in the housekeeping portion, Katie?
Nope.
Okay. All right. So I wanted to point out two of the sources that we used for a lot of our information here. One is Investopedia and one is the Consumer Financial Protection Bureau. We have links to both of these later on in the slideshow, and they have a ton of great information, not only about credit cards and credit, but about all kinds of financial topics. So our agenda for today, we're going to talk a little bit about understanding what credit cards are, what interest is and what an APR is, how to choose a card, building credit history with credit cards, what the Equal Credit Opportunity Act is, some tips and tricks for using credit cards, and then we'll have a Q&A portion as well. All right, Katie, you want to go ahead?
Yeah, so first we're going to talk about the difference between debit cards and credit cards because they sometimes act the same, but then sometimes act very different. So debit cards are going to be connected to your bank account and they take money directly out of that checking account anytime that you swipe them at the store. So you can't borrow money with a debit card because it's limited to however much money is in your bank account. And debit cards also don't help you build what is called a credit history or have a credit rating. And then the difference to that compared to credit cards, those are credit cards are accounts that will let you borrow money from whoever issued your card to you. So it might be a bank that issued your card, some corporation. So you're borrowing money from them and they're sort of paying your bill until you end up paying them back over time. And then every month that you don't pay back that money in full, you'll be charged interest on your remaining balance of whatever is left. And then for both of those, there are two dates that you also want to think about. You've got a transaction date. So that is the date that you made a purchase or swiped your card somewhere. Those transactions will usually sit in sort of a pending date category until the company actually processes that transaction for you. And then your posting date, once it moves out of that pending category, it becomes the posting date. So that's the date that the charge will deduct from your balance, whether you're deducting out of your bank account or it's deducting your available credit that you have on your credit card.
And we wanted to talk about some of the pros and cons of credit cards. Credit cards can, of course, be helpful for large and unexpected purchases or emergencies, and they also help establish and build credit history. So if you use your credit card judiciously and you pay your bill on time, it helps to establish a good credit history and a good credit rating. And we'll talk a little bit more about why a good credit rating is important later on. Some cons include that carrying a balance every month, if you're not able to pay back in full the money that you borrowed, it means that you'll owe interest to your credit card issuer. And it's best to pay off your balance each month. And your card issuer won't allow you to use another credit card to do that. So you have to have actual funds available in your bank account, whether it's checking or saving, to pay off your credit card to avoid those interest payments. And credit card debt can build up really quickly. All of the small, like $10 or $15 purchases that you might make without thinking about it too much can build up really quickly on a credit card. And I think sometimes it feels like free money, but then you're reminded that you're going to have to pay it back plus more. So that debt can be a really slippery slope.
All right, and then interest plays a really big part with what we do with our credit cards. So you may see interest referred to, or you may see APR referred to, and APR is the annual percentage rate. So that is the amount of interest that you owe to whoever gave you your credit card on any balance that you have left. So if you have swiped your card for $500 one month and only paid off $100 of that, you're going to be charged interest on that $400 that you have remaining. And you want to pay close attention to what that APR number is listed whenever you're applying for a credit card. Because if you get one with a higher number, which means a higher percentage, it can mean that you end up owing hundreds or thousands of dollars in interest over a card that might have had a lower interest rate on it. And that's anytime you're carrying a balance. And research has shown that at the end of 2022, that last quarter, Americans were owing $986 billion in credit card debt. And a lot of that is related to interest that accumulates on top of all of our purchases. That sort of average APR that you might see these days is 24%, but your rate could be higher if you don't have a good credit history or maybe you have bad credit. And they can also vary on who issued your credit card to you. So the type of financial institution, a bank versus a credit union, could change it. You could also see a different interest rate on the type of transaction that something is. Was it just from swiping? Did you do a cash advance on your card? Did you transfer a balance? That could change it. And then even the type of card you have, if it's something like a rewards card, could have a higher interest rate. So charging people money through the interest rate to then give you your rewards later. And credit unions tend to have a little bit lower of this APR because credit unions compared to banks are sort of member owned and member driven. And so they want to give you that benefit of having a lower interest rate. And then why does this matter? So interest charges will usually end up on your card about 1 month after you made a purchase. And this is if you have not paid off the balance of that purchase in that month. So any purchases that you haven't paid off that are carrying forward month to month, you're going to get charged interest on those every time. And if you didn't pay it off, there may not be a grace period that lets you get so many sort of free days before they start charging you. By law, the credit card issuer has to offer a grace period of about 21 days before interest will start accruing on a purchase. And if you pay off your balance within that time frame, then they have nothing to charge you interest on, which is always why it's important to be paying off our balances on our credit cards as much as possible. And then when you're looking at your current credit card or if you're looking to get a new one, read the fine print on everything. You want to look if they list that they're going to charge you interest daily or if they only charge you the interest monthly. And if you're getting charged daily, you're going to end up paying a lot more money in interest charges. And so if you've got one card and you're like, I don't like this card anymore, I'm going to switch to something else, but your first card had monthly interest charges, even if you switch to a card that has a low interest rate, if they're going to charge you it daily, you may end up paying a lot more money than the original card that you had because you're being charged every day. So you might end up paying 30 more days worth of interest versus just that one day at the end of the month. And then you'll also want to, again, read our fine print. Do you have a fixed or a variable APR? So fixed means it's always going to be, let's say 24%. That number is never going to change for whatever reason. Or if it's variable, it might be 24 right now, but if you don't pay your bill, maybe it goes up to 30. Or it's variable based on that type of transaction that you're having. So you always want to read your cardholder agreement and figure out which it is. And if your APR is going to change, like if they would suddenly shift it from 24 on all of your purchases up to 30, like I had said, they have to give you an alert on that. So it shouldn't come as a surprise as long as we're reading the materials that our card issuer sends to us. Yeah, and then some things like cash advances or late payments, those tend to be a lot of those variable rates and they can be a lot higher interest rates on those. So if you're getting a cash advance, it might charge you something completely different than the interest for when you're just swiping at the store. So you want to read your credit card statements or the cardholder agreement that you got when you first got your card. All right, and then Annie's going to talk about credit history.
Yeah, so we mentioned before that credit cards can be a good way to build credit history. And so we wanted to talk a little bit about what that is. So when you're using credit cards responsibly, then either regular cards, non-secured cards, and secured cards, which we'll talk about the differences, I think, on the next slide. No matter what kind of card it is, it'll help build a positive credit history, again, if you're using it responsibly. So good credit history is a combination of things. So you want to make sure that you're making regular payments on time. You're avoiding those late payments and any late fees, including interest being accrued. And then you also want to keep your credit utilization under your credit limit, which means if you apply for a credit card, they might say you have a $10,000 credit limit, and that's as much as you can borrow. And if every time you get a credit card, you max it out right away, then you're not really keeping that utilization under your credit limit. You also want to maintain a low debt to income ratio. So you want to make sure, based on how much you're making every year, that you're not racking up debt that is much, much, much higher than your income. But by making responsible purchases and paying them off in a timely manner, your credit score will rise. And it also has a lot to do with the longevity of your credit as well. So it can be a little hard to get started if you haven't had any debt before, or if you're just starting, or you want a credit card for the first time and you don't have, a mortgage or a car payment, then it can be really hard to start building that credit. But opening a secured card, which again, we'll talk a little bit more about later, is one of the most simple ways to get started. And you can also build credit by becoming an authorized user on an established credit account, such as a parent or a spouse. Then their credit history will appear on your account, and it adds to that longevity of your report. But you want to make sure that the person you are partnering up with, whether it's, your spouse or your parent or whoever it might be, you want to make sure they have good credit, or else their poor credit score can bring yours down as well. So why is it important to have good credit? It's not only so you can get the best APR and interest rates on credit cards and get the, higher credit limits, but also it'll get you more favorable interest rates on bigger purchases like car loans, personal loans, and your mortgage payments. So we want to make sure that we're always working to get a better credit report so we can get those better rates.
So if you don't have a card and you're thinking about choosing one, or maybe you're wondering, do you like your current card and you're looking for something else? These are a few things that you want to think of when you're picking a credit card for yourself. That credit score, like Annie said, is going to have an impact on your odds to get approved for any credit card, no matter what type you're going for. So it helps to know sort of what your number is, to know what your options are. If something's going to require an 800 credit score and you don't have that, you maybe don't want to even waste your time applying for it if you're not going to get approved for it. But beyond that, here are some other fun things to think of when we're picking our cards. If you've never had a credit card before, or maybe you currently have bad credit, you might need to look at what is called a secured credit card or a subprime credit card. So, a secured credit card means that you secure the card with what is called a security deposit. You may send the company $500, and then that card, your line of credit is only going to be $500 worth. You couldn't spend over that. And they keep that security deposit as you swipe and use your card and you make payments on it. They keep that security deposit in case you intend to not pay for your credit card then. But if you've shown a consistent habit of being able to be responsible with it and pay it off over time, eventually you can get that security deposit back. And then a subprime credit card is a little bit related. These are cards geared toward people who have what is called fair to bad credit. So your credit score is going to be under a 619. They're generally going to have, again, a lower credit limit. They may require you to do an upfront deposit as well. But if you pick either of these, if you pay it back consistently over time and you're using it responsibly, those payments will help your credit score go up. And then you'll have the ability later to get a different type of a credit card, or maybe move away from the subprime, or maybe get that security deposit. And then if you have a fair to good credit score, you've got a little more options out there, and you sort of can pick from different things. So some credit cards have what are called travel rewards. Every time you swipe, you're going to earn points or miles that you can then trade them in for things related to travel. So if you're a person who likes to go traveling, this might be a thing that you want to look at. You can trade those points maybe for flights or paying for a hotel or a rental car. Your perk is that you can then continue to travel. There are cashback cards. So again, as you swipe things, if you're not traveling a lot, doesn't make sense to get a travel card, but if you're swiping, you can do a cashback. Those swipes convert to points, and then again, you trade in those points for maybe cash back on your card, so they pay for part of your bill then, or some of them even give you little deposits in your bank account. So that might be a better fit if you don't need to be like getting free flights because you don't like to travel, then looking at a cashback might make more sense for you. And those ones sometimes have categories that make sense to spend your money in. So they might be like, this month your grocery store will give you double points. And then, you'll get extra points whenever you're swiping at the grocery store. So more cash back for you. Balance transfer cards. These are if you've got a really high balance on another credit card with a really high interest rate, you may transfer it to a different type of credit card that might have a lower interest rate on it. And so, what that does is it saves you money over time. They'll let you transfer a large amount of money over, but with that lower rate, it means you're not paying out as much in interest, which means you can pay more towards what's called the principal on your card. So, those were like the original charges that you had off. And again, that will help you improve your credit score because you're better able to make those consistent monthly payments. This is one of those you also want to read the fine print on them to know if that lower interest rate is all the time or if it's just for a promotional period like for only 12 months you get this low rate and then after that it's going to jump up. So just read whatever you're signing up for. You might also find credit cards that offer a low APR or no APR at all, which is always great if you can find that. So, if you routinely again carry a balance from month to month, you may want to switch to something that will charge you less because you'll
Oh,
save that interest again. And again, the low or no APRs are usually time limited. You might get 12 to 18 months. So read that fine print and see how it is set up. Also, with this and the balance transfers, you want to check, I guess it's more with the balance transfer. If you've got a lower rate for, let's say, 12 months, what happens after that 12 months if you didn't pay off your full balance? Some of them may just charge you the higher interest rate on what is left of your balance that you transferred. Some of them will charge you interest as if you still have that whole amount at the higher limit. So if you're going to be making a balance transfer, check what the rules are for whatever card you signed up for to see how much time you have to pay it off without getting dinged with a higher rate then. And then lots of stores these days offer their specific fancy store card or a branded card. These generate customer loyalty because you'll keep going back to that same store to keep swiping that card. Some of them you can only swipe within their store, but by doing so, you get access to discounts or different sales. Some are partnered with Visa or MasterCard, which are those national credit card chains that will let you swipe that card in other stores as well. So, again, just read can you only swipe it in Target or can you swipe your Target card elsewhere? Because you'll want to know how you can use it. And then also make sure that you're getting the best use out of those promotional things that it offers you. And then for any card that you pick, check to see if it has an annual fee that you're going to end up paying. There are a lot of credit cards out there with no fee whatsoever, but some do carry an annual fee, which could be anything from $50 to $700. And you want to compare how much that fee is every year to what type of rewards and incentives you're going to get for shelling out that money. If you're paying $700 just to have a credit card in your wallet and you are never going to use the benefits that it gives you, that maybe is not the card for you to be picking. Versus if you're like, I'm paying $700 and actually all of the benefits they give me are valued at 800 and I'm going to use all of the benefits every year, that might make sense to you then. So just read and check what your options are for any of these cards that you're picking.
And we also wanted to just discuss briefly the Equal Credit Opportunity Act. So, the ECOA is a federal civil rights law designed to ensure fair lending practices. So, this is what prohibits lenders from discriminating against loan applications, with the sole exception being their ability to repay the loan. So, the only thing that they're allowed to base the decisions about credit limit or interest rate is what your credit score is, whether or not you're able to repay the loan. So you want to make sure that you're aware of your protections under the Equal Credit Opportunity Act and research credit opportunities and available interest rates and make sure that you're being offered the best rates for your particular credit history and financial situation. They are not allowed to discriminate based on race, color, religion, national origin, sex, marital status, age, eligibility for public assistance, and they also have to follow specific consumer protection laws.
Right. And then just some final tips and tricks for us. Whatever credit card you have for yourself, always check your statement that you get monthly and then check the types of transactions that are showing up on it. I know this can sometimes be scary if you are carrying a large balance on a credit card and you're like, I would rather just not look at that and know this. But you want to make sure that the transactions showing up on your statement are things that you have done and someone didn't get a hold of your credit card and make some fraudulent purchases. So go through line by line. Does this look familiar? Did a store accidentally charge you twice? That's something you can fix and they'd have to give you your money back and then you don't owe as much on the card. Or if there was a fraudulent purchase, again, you can work with your credit card issuer to get that off so you don't end up paying for it. This can also be good if your kids know your credit card numbers or you've put it into like Apple Pay, that they're not in some app spending wildly on your credit card, making purchases in apps on their phones or their mobile devices. That is also something you can work with them, work with your credit card company to figure out how to pay for that. But just check what's going on because if you can get something taken off that shouldn't have been there, it'll just make you feel better about what is left that you do have to pay. For card issuers and billing errors, if you notice a billing error, something shouldn't have been charged correctly, and you ask for it to be fixed, they can't take more than 90 days to resolve that billing error. So I would suggest get a little notepad, write down when you contacted them about an error that you noticed, look at a calendar and count out 90 days. If you don't have a resolution by that point, you got to get back in touch with them, preferably before the 90 days, and be like, hey, you're going to fix this, right? But if it has hit after that 90 days, the Consumer Financial Protection Bureau, this is what they love to do is to help protect you, the consumer. So they have some tips and tricks on their website how to handle that if the card issuer hasn't fixed it within that time frame. And then for lost and stolen credit cards, why pay for purchases someone else made if you lost your credit card? We don't want to have to do that. So as soon as you notice your card was lost or stolen, give your credit card a heads up, the credit card issuer a heads up about that. You can't be held responsible for those unauthorized purchases or the interest on those purchases. So the sooner you can let them know someone stole your card, the sooner you can get that card number shut down so they can stop using it, and then you get a new card sent to you, which is great. And then you make sure you're not being charged and having to pay for all of their crazy purchases that they're making. And a lot of apps these days that are connected to your credit card, if you think you lost it, but you're not sure where, you can go into your app and freeze that card until you find it. And again, no purchases can be made on the card while it's frozen. But, if you lost it in your car somewhere and you just need like a moment to find it, you can freeze it in case someone else would find it first. But then no random purchases end up on there. It gives you time to find it and then you unfreeze it when you're ready to use it again. If you're a person that gets lots of credit card offers in the mail and you do not want to get those credit card offers, there is a number that you can call and a website you can go to have those stop ending up in your mailbox. So again, these notes will be in the email that we send out, but it is called optoutprescreen.com. You go in there, put some of your information in, and it pulls your name off of those mailing lists that people use. And then consolidating debt, this happens a lot. If you are a person that still has access to TV and you're watching and you see ads on TV, I've seen them pop up online sometimes for companies that are willing to consolidate all of your debt into something. Some of them are legitimate, and those would be the companies that you want to find and work with, but some of them are not legitimate, and they'll say they are consolidating your debt when they're not actually doing it, or they're going to charge you some absolutely ridiculously high fee to do so, and there are better companies to work with instead. They can be risky, but some can be legitimate. So if that is something you're thinking about, you may want to first talk with a nonprofit credit counselor who can guide you to what some of the more legitimate companies would be. And we have one that we will recommend later. But work with someone whose purpose is not out there to get a profit off of you, and they can guide you in a better direction. If you're struggling with a really high monthly payment, that nonprofit credit counselor is great to work with, but you can also work with your creditors then to see what they're willing to work with you on to reduce what those monthly payments are. It's always worth calling and asking your credit card. It sucks when they say no, but if there is something that they're willing to work with you on, at least you've taken that step to ask them. And then if you do decide to close off a credit card, Give the company a call, say that you want to close it. They'll close the card, but you still owe that money. You still have that debt that you have to pay back. And they may still charge you interest on that debt until you get it paid off. And so, again, this is one of those, if you're going to call and cancel it, ask them specifically, will there be interest accruing on this? How much? Or check that cardholder agreement that they sent you at the beginning to see that information. And then just remember that closing an account could have an impact on your credit score for a couple of months. But if that's what you need to do to not be spending wildly on a credit card, or you're just like, I have too many of these and I don't want them all, definitely something to take a look at. All right. And then Annie's got some resources for us.
And I see we have some questions in the chat. I'm just going to go over these resources quickly first, and then we can talk about those and any other questions that folks might have. So a lot of the information in this slideshow came from Investopedia. They have plenty of information for consumers about not only credit cards, but all kinds of financial topics. And as I mentioned, you'll get a copy of these slides with the link, so you'll have access to these resources. We also have the Financial Empowerment Center. They have plenty of resources, and they are at our office in Turtle Creek each Wednesday doing personalized appointments to help with financial planning and questions. So we really recommend working with them if you have questions, whether it's about paying off credit card debt, improving your credit score, budgeting, really any financial topics that you might need a little one-on-one personalized help with. They're definitely your go-to. Advantage Credit Counseling is a nonprofit organization that offers private, confidential budget credit counseling and also provides a special debt management program. So they're another resource that you might want to check out, especially if you're struggling to pay back some debt that you have. They're a great option. They have some programs to help with that. We have a YouTube channel with all of our financial literacy webinars, and we have a specific webinar from the Financial Empowerment Center that goes into detail about getting your credit report information and fixing issues on your credit report. So that's another great resource to check out. And you can also find more information and resources about credit cards and plenty of other financial topics with the Consumer Finance Protection Bureau website as well. So some questions that we see in the chat here. Are there any lenders who don't do a credit check? There are some that don't do credit checks, but you want to be careful because oftentimes I don't want to say all of them because I don't know this for sure, but a lot of them can be predatory, what they call like payday loans, where you're paying a much higher interest rate or a fee up front to get that credit. So you really want to do your research. There are a few. I think Affirm is one. You would have to do some research on that. That's just one I happen to know off the top of my head, that I think that they don't do a lot of credit checks, or they'll still take folks with lower credit ratings, but I don't know what their interest and repayment schedule is like. But you can also look for those secured and subprime lenders. Those are two keywords to use in your search to find those, where if you're able to pay that security deposit, then you can build that credit history back up and then, start looking at other credit cards that are available. How many credit cards should you have to build good credit? Katie, do you want to take this one? I feel like we were just talking about this earlier.
We were just talking about it earlier. I have heard that the credit bureaus, so there are three credit bureaus that put together your credit reports. And then when like a car loan place is pulling your credit report, that's where they go to look at your information. They like to see a variety of debt basically on your credit reports between mortgages and car loans and a handful of credit cards. That being said, I, for the majority of my life since I turned 18, have had one credit card at a time. I currently have two, because one is with my credit union that I have had since I was 18. So I'm not going to close that because it is my longest standing account. But I do have a rewards card with another company because it gives better rewards. I don't feel the need to go over two credit cards because I know that I can responsibly spend on the two that I have, and they provide me a high enough credit limit that it should cover pretty much anything that I need. I think the thing to look at is not necessarily like a specific number of you need 7 credit cards or something. It's more, what are you doing with the credit cards that you have? If you can't consistently pay off your credit card every month, adding another one is maybe not necessarily the way to go. You can raise your credit score by consistently paying something off. Or if you can't pay off, We love it when we can pay off the whole amount because then you're not being charged interest and owing even more money. If you can't pay off the whole amount, can you consistently be making monthly payments on something? Even those actions go into building your credit rating and your credit history. If you've never looked at your credit history before, they give you this cute little chart that's like, here's 36 months. Did you pay your bill on time or not? So getting that green, like, yes, check mark, or the red X, like that is also going to impact your credit rating then.
Yeah, and credit history is really, when you're trying to build good credit, it is kind of about finding a sweet spot, and sometimes it is not always super intuitive. Like, even if you have a lot of debt and you open a new credit card, then your credit score might go up a couple points that next month, and then it'll drop back down. So it is fluctuating. And even if something initially is going to increase your credit score, that doesn't mean that it's going to remain that high over time. So again, like Katie said, you don't want to just like keep adding more credit cards on for that initial boost, especially if you're already struggling to pay them back. As far as utilization, which is our next question, what utilization should you stay below? I didn't know the answer to that off the top of my head. And when I saw that come in the chat, I did a quick research. And what I was coming up with was a lot of people were saying that you should stay below 30% of your credit limit. Some people said 10% is even better, but 30% is that like the sweet spot that you definitely want to stay under.
And then I'll take the next question. How long should you wait before asking for an increase? Again, I think this answer for the time is going to change based on your personal situation. If you just got an increase, like you don't need to ask for one every month, but if you recently got a promotion at work and maybe you earn more money, you can ask for an increase. The card issuer sometimes says, like, oh, type in this little box, like, what is your current salary or pay? And based on that, they'll give you an increase. Or if you've been able to consistently be paying on your credit card, whether that's paying it off every time or you're making like consistent monthly payments, at that point, that's kind of like a sweet spot of when you want to ask for it because you're showing the card issuer that you're being responsible with what they have given you so far. And you have a better chance maybe of getting an increase to your credit limit. And then, just because they increase your credit limit doesn't mean you go wild and spend all of that money again. But it is nice if you would keep your spending consistent and they raise your credit limit, that means your utilization percentage has changed also because you've got more available credit that you're not spending. So that will like show that you're utilizing less of that amount. So that is actually good then when you can get those. I think my rewards card maybe every 6 months sends me an email and it's like, "Hey, what's your income right now? Did it change?" And I like go in there and let them know if it's changed or not. I don't always get an increase, and that's fine. I don't necessarily need it. It's just nice because it would change my credit utilization rate then.
And we have another comment here in the chat. I have several cards I don't use, but I'm scared to close them because it'll hurt my score. My kids are grown now, so I don't use them. I would say if there's a card that you're not using, I think that it would be better to close it. And then maybe if you have space, you want to keep working on building your credit, finding a credit card with rewards or points or something that is more relevant to you. So you're not just carrying a card around that, you know, you're worried about, you don't want to forget about, closing that one out and then using that like space in your wallet to get a card that maybe is something that'll help you out a little more. And again, even if you close it, once you pay it off and you close it, then even if there's like an initial, I want to say a ping of like your credit history because you're losing that line of credit, generally having less debt is going to be more helpful, I would say. Again, it fluctuates so much that it might change over time.
I'll take this next one because we've had this conversation a lot, Annie, leading up to this. Is it better to pay on the statement date or the due date? So, for those who don't know, when your credit card issuer sends you your bill every month, there's going to be a couple dates on there. It will say like what is the time frame that this spending was between. It's usually a 30-day period. One of mine weirdly falls from like the 9th of the month to the 8th of the next month. It's a very weird cycle. I don't know why it's those dates. Yours might be the 1st or the 30th. You'd have to check, but you'll have Here's the 30-day period that, these transactions happened in between. Here is the statement date, which is the date that this bill is being generated. And then here is the due date, which is the date that we want you to be paying us by. And which date is it better to pay on? Definitely pay by the due date. And I would even say if you're paying online, I would backtrack it 2 days at least, pay by that date so it has time to process by the time it would actually be due. Or if you're mailing in a payment, if you're a person who mails in payments, backdate that a week so that it has a week in the mail to get to them before they like cash your check then, and you want it to arrive on time. So you definitely want to be paying by your due date. However, the sooner you pay something off, the less time it's going to be sitting on your credit card and potentially earning interest. And this was my like, I teach finances and even I screw up sometimes. I had a moment this spring where I was moving and ended up getting injured and like a whole lot of stuff happening at once. And I realized I was 2 days late paying my own credit card bill, even though before that I paid on time all the time. So once I realized it, I made a payment right away because paying it as soon as I could was better than waiting for the next bill to come out. And even though it was a few days late, it was time for interest to kick in. So I got interest being charged on my own card. I did call the company and say, "Hey, I've never missed a payment before. What are the chances you'll take this interest off?" And they did. So if you've never tried that with your credit card company because you've never missed a payment before, it's worth asking. The worst they do is they don't take it off, but it's nice when they do take it off. But then my next monthly bill that came out, I had interest charges again because it took rid of that interest that would have been from the original statement cycle. Then there was that few days in between when one cycle ended and I made a payment, and all the interest was accruing during that time as well. So you definitely want to pay by your due date, if nothing else. But if you can pay things earlier, you might interrupt that interest cycle from hitting another 30-day mark. You might only have 5 or 10 days of interest then that it had built up instead of it being another 30. We love it when we pay off credit card bills in full so we don't have this issue. But if you can't, like, also, you won't forget then. If you get that bill in the mail and you pay it that day, you've taken care of something. Yeah.
And I think another thing we were talking about earlier, I think it depends on you as a person as well. Like when we were talking about it, I said, I'm paperless, so I don't get my credit card bills in the mail. And so I am not great at remembering what my due date is. So I pay my credit cards every time I get paid because I see that money come in and I go, okay, I saw it come in. I'm just going to go pay my credit card right now. And while that may not be the most helpful for a credit score because then it doesn't show that I'm carrying debt for as long, but I know that if I don't do that, I'm going to miss my due date and I'm going to get interest. So there's sometimes you have to find what works best for you. That if you know you're like me and you're going to miss the due date, then you have to find another way to remind yourself to pay it. That's better than like accruing a bunch of interest because forgot your due date and remembered a week later. And auto pay, someone asked in the chat, is it better to auto pay? If you have the means to auto pay it, if that won't cause like an overdraft on your bank account, then I think setting up auto pay is great. I'm asking myself now, why don't I set up auto pay? But yeah, as long as you're sure that it won't cause like an overdraft on your bank account and cause you troubles there, then I think auto pay is a great option.
And I would also say sign into your credit card issuer if you've got a website or an app and see maybe what type of alerts they have available that you can set up. Like I've got an alert every time my card is used that I get like a push notification on the app and also a text because on the one hand that helps me check if someone has stolen my credit card number, like these purchases all look okay, so I'm okay with it. But I can also set up things that push an alert to me that says your bill is due in X number of days. So that's also like another thing that'll pop on my phone so I remember to go and make that payment. So if you haven't explored what alerts are available through a website, maybe it'll send you an email, or if you've got an app, that might help you remember when you want to be making a payment as well.